Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Marriott stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 68 billion market cap. They're trading at $238 a share, and they have 286 million shares outstanding. Marriott International operates, franchises, and licenses lodging brands that include hotels, residential, and timeshare properties. It owns over 30 hotels and timeshare brands, with almost 8,800 locations and about 1.6 million rooms across its entire network. That is a lot of rooms. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 2021 was a rough year due to COVID. A little under $1 billion of free cash flow. Look how low their revenue was, $14 billion. It more than doubled to $2 billion in 2022, up 34% to $2.7 billion. It is down in the trailing 12 months at $2.6 billion. But still plenty to cover their dividend. They pay out $700 million in dividend payments, which is a 1% yield. Not great margins, but not as bad as I thought, 11%. That means they convert 11% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That tripled from $1.1 billion to over $3 billion. It dropped a little in trailing 12 months at $2.9 billion. But it looks like they got out of the COVID slump. Things are looking up. Revenue is a sales for the company. That nearly doubles from $14 billion to $24 billion. A nice steady growth since 2021. Revenue per share at the highest level since 2021, $84 per share. To calculate revenue per share, it's revenue, which is $24 billion, over shares outstanding. Since each share price is $238, that implies their price of sales is about a 3. Price of sales is stock price over sales per share. Or market cap, that's $68 billion, we saw that earlier, over revenue, $24 billion. So it's not quite a 3, a little better than a 3. It's probably closer to 2.9. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $58 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $51 billion. We divide that by 286 million shares. And we get a calculated stock price of $178. They're trading at $238, so they're trading at a 34% premium. It's a big fat sell according to the model. There are 12 companies in the same industry as Marriott, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. I plan to do a video this week on each of the top 6 companies. Hopefully I get through all 6 videos. In terms of CapEx, they spend the most. These are investments in property, plant, and equipment, $466 million. We can't look at their debt to equity ratio. They have negative equity. Same thing with the price to book, negative equity. We can't look at the price to book. They pay a 1.1% dividend. The top 7 companies pay a dividend. Wyndham pays the biggest at 2%. They're third biggest at 1.1. They generate the most free cash flow, $2.6 billion. They generate more than Hilton, but they do generate less free cash flow than Hyatt and HTHT. HTHT is a Chinese company. Of course, they generate the most free cash flow on a nominal level, but as a percent of their market cap, it's worse because they have a higher price to free cash flow. They do have a better price to free cash flow than Hilton and Choice, but not nearly as good as Wyndham and Ator. Greentree has the best. They're trading at 24 times earnings, in line with the median average, 2.8 times revenue, in line with the median average. Earlier I said it was 2.9, I was pretty close, 2.8. They generate the most revenue by far, $24 billion, but not as much as Hyatt as a percent of their revenue, because Hyatt's price of sales is 2.3, which is better than 2.8. They are growing, but their 5-year annual revenue growth rate is pretty low, only 3%. The Chinese company H-World is 15%. Hyatt and Choice are doing well at 8%, but Wyndham is regressing, negative 7%. If you put $10,000 into this company 10 years ago, you'd be really happy at $45,000 today. That's a 16% annual return. But from 2014 to 2020, you would have been pretty much flat, up a little bit, maybe 5-10%. But it really blew up since that March 2020 bottom. Let's peruse their first quarter earnings results. You may see the term RevPAR, that's revenue per available room. I just started working for a real estate developer, and we develop hotels, so I'm getting used to that term. Because if you compare two companies and they both own 5 hotels each, that doesn't make them equal companies. One company may have 5 hotels with 10 rooms per hotel. Another may have 5 hotels with 200 rooms per hotel. Much different companies, vastly different sizes. So RevPAR increased 4.2%, so that's about inflation, maybe a little worse. 1.5% in US and Canada, 11% internationally. Revenue forecast for the second quarter is $1.35 billion. For 2024, it's $5.2 billion. So adjusted EBITDA, $1.3 billion for next quarter, $5 billion for 2024. That's pretty good margins. Their EBITDA is the same as their revenue. It almost seems impossible, right, to have revenue the same as EBITDA. But hopefully we'll learn more about the company as we go through the slides. CapEx spend $1 to $1.2 billion, and they will return $4.3 billion to shareholders. That's through dividends and buybacks. Mostly buybacks, because I think they only pay $700 million of dividends. Here's their first quarter income statement. Revenue $6 billion. That's up from $5.6 billion. Some of their hotels are franchised. They receive $1.2 billion from their franchisees. Franchise fees, $700 million. That's the upfront fee when you buy into the franchise. $300 million of management fees. They charge a fee to manage the properties. And $200 million of incentive management fees. They receive bonuses or incentives if certain milestones are hit. Like occupancy is above a certain number. Total revenue is above a certain number. Most of their revenue is from cost reimbursement revenue, $4.4 billion. These are expenses they charge the property owner for various programs and services Marriott provides to them. An example of that is marketing. Now it makes sense why their margins are so high, because other people are responsible for operating the hotels. They just charge fees. Their biggest expense is reimbursed expenses. These are the programs they offer to the franchisees that operate the hotels. So it's kind of like a break-even proposition. They spend $4.5 billion on the programs and they receive $4.4 billion of revenue. Operating income $700 million, that's down from last year, down 14%. EPS $564 million, down from $757 million. Their taxes are up a lot, up 87%. It was $87 million, now it's $163 million. They are buying back a lot of stock. They had $310 million last year. They knocked off nearly 19 million shares, down to 290 million. That's where most of the return to shareholders goes, to buybacks, not dividends. This is their GAAP income statement. Next page is their non-GAAP. For non-GAAP, they have $1.5 billion of revenues because they strip out those reimbursements. That's why their operating margins are so high, 62%. Their adjusted operating income is higher in the first quarter of 2024 compared to the first quarter of 2023. GAAP operating income is lower in the first quarter of 2024. Net income is a lot lower, 25% lower. But non-GAAP net income is only 4% lower. But their EPS is higher because they have less shares outstanding. That's more important to look at, EPS, than net income. Because if they're buying back stock, they deserve the credit for that. And the credit is a better EPS, earnings per share, because they're spreading the net income over less shares. So if you were asked a trivia question, a company has less net income than last year, will its EPS be higher or lower than last year? And your answer should be, I don't know. It depends on how many shares they have outstanding. In the US and Canada, they manage 620 properties, 214,000 rooms. International is a lot more than double, 1,300 properties. But their rooms are not quite double, 350,000 rooms. Almost 2,000 properties they manage, 566,000 rooms. Marriott is their biggest in Sheraton, Courtyard, Westin, JW Marriott. They don't own as much. They own 13,000 rooms. Franchised, they franchise over 6,700 properties, over 1 million rooms. That's why their margins are so high. Most of their locations are franchised. Those companies have to deal with operating the hotels. Marriott just collects royalties and fees, which is a great business model. Residences, where people live, 126 locations, 14,000 rooms. Ritz-Carlton residence. I wouldn't mind living in a Ritz-Carlton. In their luxury segment, 626 properties, 157,000 rooms. Premium, 2,300 properties, 700,000 rooms. Select, 5,700 properties, 740,000 rooms. Then you have mid-scale and timeshare. So total 8,900 properties, 1.6 million rooms. US and Canada, 6,000 properties, 1 million rooms. International, 2,800 properties, 600,000 rooms. Just to be clear, I went through the same data in two different ways. They broke down all their properties and rooms in terms of franchised or licensed and residences. Most of their properties are franchised. Then the next section is the same information, but they break it down by luxury, premium, select, mid-scale, and timeshare. The same 8,900 properties and 1.6 million rooms broken out in a different way. Revenue per available room is the highest at the Ritz, $351. The average daily rate is $539. The reason this is higher is because some rooms are vacant. So they're spreading this $539 over all the rooms, even the vacant ones. RevPAR in US and Canada for luxury rooms is $314. For premium rooms is $150. For select rooms, the cheapest $117. So the average is $171. That's only for company operated. If you include the franchises system-wide, the RevPAR is $120. For international, company operated is $122. That's RevPAR. All international, $115. Here's a nice breakdown of each quarter in 2023. Net income, it peaked in the fourth quarter, $848 million, $3.1 billion for the year. Adjusted EBITDA peaked in the second quarter at $1.2 billion, $4.7 billion for the entire year. Let's take a look at the company on Simply Wall Street. Its last price, $237, $66 billion market cap, down 1% in the past week, but up 38% in the past year. Let's see what they say about the company. Marriott International operates, franchises, and licenses hotels, residences, timeshares, and other lodging throughout the entire world. It has many properties: JW Marriott, Ritz, the Luxury Collection, W Hotels, St. Regis, Edition, Bulgari, Sheraton, Westin, Renaissance, Delta Hotels, Tribute, Gaylord Hotels. That must be someone's last name or first name. There was a picture of Gaylord Perry. The Four Points Sheraton, Town Place Suites, AC Hotels, Moxie Hotels, Element, etc., etc. They also own yachts. I didn't know about that. They were founded in 1927, headquartered in Bethesda, Maryland. Here's the stock price since '98. It was $17. It got over 50 in 2007. Great Recession came. I think that was its lowest point ever. It actually fell below $11. Then it had a nice run up to over 150 in 2019. COVID came. It crashed to 70. And look how much it's gone up since then. It hit almost 260 last month. And their highest point ever was 411. It's down almost 10% since that peak. I guess that's why my model says it's overvalued. Simply Wall Street says they're 5% undervalued. Their target is 250. 22 analysts priced this stock at 247. Revenue forecast for 2026, $29 billion. Free cash flow forecast for 2026, $3.3 billion. Their revenue in 2013 was $2.5 billion. Then it grew to $5.4 billion in 2019, dropped a lot from COVID to $1.8 billion. Now it's at its highest ever, $6.4 billion in the trailing 12 months. This red line is their debt, the blue line is their equity. In 2013, debt of $3.1 billion, equity of negative $1.5 billion. Then their equity finally became positive in 2016, positive $5.8 billion with $8.8 billion of debt. But their equity is back to negative, $12.5 billion of debt, negative $1.6 billion of equity. And this green line is their cash. They currently have $400 million of cash on their balance sheet. It doesn't look too hot. Their dividend back in 2014 was 1.2%. It peaked at 1.8% in 2016. They cut their dividend to zero in 2020. They brought it back, and the forecast for 2026 is 1.2%. The CEO's salary is $800,000 in 2017. Now it's $1.4 million. You gotta love inflation. Total compensation, $23 million. Tenure as CEO, 3.3 years. In the past year, you won't see any buying, but you'll see a lot of selling. Look at all these sales. Some people with the last name Marriott, and the list goes on and on and on and on. If you add this up, it's close to 300,000. 65% of the company is held by institutions, 22% by the general public, 8% by insiders, and 5% by private companies. Their biggest shareholder is Vanguard at 7%, then BlackRock, 5.5%. The family, the J. Willard Marriott entity, owns 4.4%. Other people in the Marriott family, you'll see some big companies like JP Morgan, Eaton Vance, T. Rowe Price. They have a lot of employees, 123,000 in 2013. Now it's 400,000. The ticker trades on the Nasdaq, Deutsche Börse, Xetra, Wiener Börse, London Stock Exchange, EuroTLX, Mexican Bolsa, the Bulgaria Stock Exchange, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.